Okay, welcome everyone. So for this Thursday night class, this is going to be kind of like a recap from the last two that we've had, those being the mirroring option chart to the actual stock chart, and then also finding the golden contract so that your risk is minimal and you have more control over your trade, more or less emotion with the trade that isn't interfering with holding longer or not really knowing what to do with anything. And the main reason why I wanted to talk about the previous two along with the one that we're having tonight, it's kind of like a three-level step to get to where we're at right now. The idea of understanding how you can correlate an option contract to the actual the actual stock chart, and also knowing which contract to buy without having to have a high risk, but also you have a you have a high reward and a low risk. There's no interference with emotions in the process. I feel like a lot of people, they understand how to enter a contract, but they're not too sure on the what's the best probability in their favor, like which contract is going to benefit them the most. Even though they may pay more, they're more focused on putting in less money to make more money back on a percent return. So the biggest thing I am going to be talking about is the risk side, just like I did over the last 2 weeks. Many people messaged me privately saying how it was a big help seeing that side talked about. A lot of people don't really mention the whole idea about like, I'm going to size light and I'm going to hold for the big move, because one contract size light, it can make more than sizing heavy and trimming too soon. And then you're kind of regretting not holding for the major move. And today's a pretty good example. I know Doc's in here and he had one of the moves that held throughout the entire day. And the one thing I tell people, I'm trying to speak on relatable concepts instead of just teaching, because I want people to understand and like relate to what I'm saying. When you size heavy and you're up 20%, 30%, 40%, you're not focused on the chart. You're not focused on like the goal at the end of the tunnel. You're focused on, okay, I'm up this much right now and I size more than I usually do. I just want to get out, because if I am wrong and it rejects on me, I'm going to lose more than what I want to do. There's a lot of stuff that people don't think about, that people don't teach new traders. So with this lesson, with predetermining the trade outcome, the major thing that I'm going to be preaching on, which a lot of people are like, I don't want to hear about the losses. I want to hear about how to make money. I want to teach how to limit losses. I want to teach people how to preserve their money for trading the next day or trading the next week. A lot of people don't understand the concept of you don't have to trade to make money long term. A lot of people think you have to trade every day. You have to sit at the monitor from 9:30 a.m. Eastern to 4 p.m. Eastern all day in the market. The biggest outcome that comes with trading is no emotion. When you have that included, every trade flows so simply. There's no heavy. Yeah. You guys hear me now? You guys hear me right now? How about now? No. Very. How does this sound? If I have to, I'll just get close to the microphone. Is that too loud or is that good enough? I'll wait for a few people to say yes or no so I can just continue. Good. Okay. So I'll stay a little close to the mic, which is not an issue for me. Yeah, louder is always better so you can actually hear everything. So I made a lot of breakdowns. I typed a lot of notes on this PDF document. This is literally stuff that happened today that I thought of. Like, I had stuff planned since Monday, Tuesday, obviously. And today was a huge day of realization for me that there's a lot of stuff I left out. There's a lot of stuff that I didn't bring up when I made this on Monday and Tuesday when the market was steady. There wasn't much going on. And I think today it was like a light bulb went off and I realized I was missing out on the key concept of how do you catch the move if you don't size heavy enough? I want to make more money, or I size too heavy, I sold too soon, and now I missed the entire move. So I tried to incorporate that today, and obviously on my flight I tried to incorporate today's market into today's lesson, because I feel like a lot of people, all they do is look back at what they missed, and they're not focused on the execution they had. They're not focused on a better entry they could have had. So I'm going to try and speak on basically the title of this section, which is how to find the trade outcome well before you enter, well before you even think about where should I enter on this contract? Should I chase on the breakout? Should I want to pull back to get in? And for those of you that do not know, the market ran upside, obviously. A huge green day. I think the S&P closed just under 2% on the day. So as I go through these notes, I am going to zoom in a little bit because this is a little bit far out, I feel like. Okay, so when we're talking about this lesson, any questions you guys have throughout this, please stop me, ask any questions. I don't plan on using the whole hour off of just me talking off of the lesson I have planned. So it's going to help if you guys, like at any point you see something on the screen that I haven't even mentioned about yet, say it before I get to it. If you have any questions or concerns, like why is that on here? How do you deal with that? How do I deal with it when I can't get over the hump of what I'm struggling with? So when you're trying to find an entry on a chart, so many people, they don't even focus on the actual option. They're not focused on what the price was when it was on a dip before the rip happened, and they want to get called. Like, how much was the move on the IV just off that one candle on the stock chart? How much was the actual move that was forced based off the volume surge? Not even the idea of the contract move upside. Now it's up 30%. Is the contract actually up that percent amount, or is it just the movement happened so quick it basically flew the IV up, the interest value, and now there's so much going on that you're focused on, I got to get in before it goes higher. Next thing you know, you enter, it consolidates, it has a slight pullback, and now you're down 10%, 15%. And your mindset, maybe I just saw it at 1.5, I entered at 1.8. It's not even at the same spot on the stock chart, and I'm back to where it was at 1.5 now. I want to make sure people understand the fact of you're not making money trading. You're trying to find a probability. I'm always talking about statistics. I'm always talking about probability. I'm always talking about the risk side. Because if you're not prepared for the risk, how are you going to keep the money you make going forward? There's so much people are not focused on long term, I want to say. And for the ones that are focused on the long term, they're kind of thinking, I want to make 1,000 today, 1,000 tomorrow, not realizing some days you may make $50. Some days you may have to cut early based off a system you have in playing and lose $100 on the day. Everyone's so focused on, I finished red, it's a losing day. I finished green, but only $100. If I would have held, I would have made $1,000. It's a losing day. They're not realizing the overall fact is you're dealing with statistics and probability. There's no second guessing a trade after you're in and then you sell it. You shouldn't second guess anything. Like what Rocky just said, some days it's okay not to trade. The biggest example I have given multiple times, and this may get old for some of you that have heard this, treat your trading account like your savings account, like your checking account. When you have money in the bank, you don't just go and spend it because I have to use it. I have to utilize my finances. There's nothing wrong with holding a trading account and not putting money out. So you don't have to figure anything is like sketchy with yourself if you just focus on, I'm going to watch and not execute. I missed my entry. I'm not going to chase. If it does come back down, I'll reevaluate, but I'm not going to force a trade just because my emotions are involved. I don't want to see the stock push another 1.0 a contract when I already missed the 0.5 move. So many things are included with emotion before you even enter the contract. So I'm hoping when we finish this and throughout it, you guys have questions to pick my mind of how I overcame it, or maybe issues that you've been having that you want to ask me for advice on. The whole purpose of this lesson is not really to teach, but more so open your eyes to the realization of a different concept of how to do all this. And Doc just said, honestly, that's why I keep my account a margin so I can't get carried away. For anyone that doesn't know, if you have a margin account that's under $25,000, you are limited to 3 trades every 5 business days. 3 trades every 5 business days. So if you make 3 trades in one day, you can't trade that account unless you want to get a PDF, I think a PFD, pattern day trader. Oh, PDT. If you trade 3 times in one day on a margin, you have to wait until the following week on that same day to get your 3 trades back. When Doc was telling me this, it made me realize he's thinking about the long term. He doesn't just want to make money. He wants to wait for the best setups. He wants to wait for the best trades. He's waiting for the best setups because he knows I have 3 trades to use in the next 5 business days. Why would I use all 3 trades on a scalp if I'm just going to get a few 20% gains? That's fine. But what if he misses a major move and then on another account he tries to chase it. He tries to force a trade that he knows he shouldn't do. The biggest thing about having a margin is you're limited. A lot of people like me now, I don't have to have that thought of I'm limited to this much money in my account to trade with. I don't care about I finished the day with 5,000 left to use for buying power, or I finished the day and I made no trades. I don't look at it that way anymore because my biggest focus, my biggest mental adjustment, I have the same amount of money I came in with today that I can use tomorrow. That's the biggest thing that's helped me. The realization that the trades I missed today, I can catch one probably better tomorrow, and I have the same amount of money. I have no emotions from a loss the day before. I'm thinking about, man, I lost $100 yesterday. It'd be nice to get that $100 back. I have no thoughts of anything. It's a clear mind. It's a new day. So when I'm looking for an entry, when I'm looking for the low risk, the high reward, what am I actually waiting for? What am I actually hoping happens before it actually forms? I'm trying to predict basically the move that's coming to me, not predicting the move that's going to happen after it bounces, after it drops. I'm trying to predict where it's going to pull back to so I can get in at a cheaper price. I'm not focused on if I buy in right now, I can maybe scalp this for a 20% huge green candle on calls. I don't care about that. I want to catch it where my risk is so small that if I am wrong, I'm selling for a 10% loss, 15% loss. So that way, if I know ahead of time, and I think I can scroll down a little bit on this. I know I have examples on the bottom. I'm going to scroll back up in a second. So if you're focused on a contract, say the contract is currently at 1.90. I don't have this typed on the shared screen, but I'm saying this until I get into what I typed on the screen. The contract currently is at 1.90, $190 a contract. Say from my perspective, based on the example on the board, I want to wait for a zone, and that zone correlates with the contract cost being 1.5. So even before the contract's at 1.7, 1.6, I'm already focused on if I wait for this pullback, if the pullback happens, there's no 100% guarantee I'm going to get in at 1.5. That's the low risk I'm waiting for. I'm hoping it pulls back to a zone where historically it's shown maybe a bounce, maybe it's shown a rejection, but once the price action is above a rejection, that now becomes support and it will bounce off that. I'm trying to lower my risk. So when the contract's at 1.9, I already know, okay, I'm going to be paying $150 a contract. So Vic said, so you have the contract chart next to the stock chart to correlate at all times. My literal trading screen, I have the actual stock I'm looking at. Next to the stock, I have the actual contract premium I'm looking at, the contract premium chart. Along with the stock chart and the premium chart, I have the tape running on both, so I know where people are filling on the option contract. And then along with the stock and the contract, I also have the SPY pulled up on the top right corner for overall market sentiment. That's usually my go-to with everything. So if I'm watching, let's say SPX at noon, I'm focused on a specific contract. Obviously, it's going to be more expensive right now than what I want it for in a few minutes or a few hours. If I want to switch to Amazon to look at Amazon, I'll pull up the Amazon stock chart and I'll find a contract that correlates with the setup that may happen. If it's looking too bullish and I see a pullback coming, I'll find a put that correlates, aka the golden contract. I will look for the golden contract that correlates with the Amazon price action to find where can I buy this contract at for a cheaper price when my risk is smaller. I don't just want to go to a contract and say I have to get in. What was the low on the day of the contract? What was the possible high on the day? So if the stock chart double bottoms on puts, I know what the highest my contract could go to. I have an idea of what my gains could be per contract. I'm always focused on this. So the contract's at 1.9. I want to get it at 1.5. So right away, I know I'm paying $150 a contract. If I have an $1,000 account, how much do you want to size? If you buy 2 contracts and you get filled, you're sizing $300, which is 30% of your account portfolio. That's when personal bias comes in. I can't tell you what to size. I can't tell you what to do. Some people can full port. Some people can size $150 a contract. So that's when it comes in your personal bias for what you know about yourself. Emotionally, can I size into one contract at 150? Say the answer is yes. Now I look for the risk. I'm focused on, okay, if I fill this, where am I going to cut based off the levels on the stock chart? Now I'm going to correlate the stock chart to the option chart. What price estimate wise would this sell be if that level on the stock chart broke? So say for the risk price, my risk is a sell at 1.3. The contract is sitting at 1.9, 1.8. I'm already knowing if I enter at 1.5, I'm going to lose the most if I follow my plan. If I am disciplined and follow my setup, I'm losing $20 a contract. I know that even before I enter. At that point, correlation. Okay, if I size 3 contracts, I'm sizing in $450. If I sell at 1.3, I'm losing $20 a contract, 20 times 3. My risk is $60. $60 of $1,000, I'm risking 6% of my account. This is the math I do even before I enter the play. I'm always focused on, okay, so if this setup, it looks really good and I know my risk is let's say a 20% loss, I want to size heavy because usually if I size, let's say $1,000 and it goes down 50% for my loss, I'm risking $500. Let's say the loss is going to be a 20%. So I'm going to size 5,000. My risk is going to be obviously $1,000 for a 20% loss. So I'm calculating this. How much can I size to keep my risk amount the same as a small position for a larger percent loss? I'm trying to figure this out before I enter. That way, so if I enter the contract and things go well against me, like I'm wrong 100%, I know for a fact if I stick to my plan, I'm only losing $20 a contract. If I bought that contract at 1.9, say it drops to 1.5, where I initially wanted to enter, I'm down $40 a contract, but that's the zone that it should bounce. So I don't want to sell yet. What if it keeps dipping? Now you're down $50, $60. You don't sell at 1.3, so you keep holding. I'm always trying to stay focused on what I want out of this. I'm trying to stay ahead of the game from the loss perspective. I don't care about the upside. The upside I'll figure out in the moment. If it bounces the way it should, the price can go back to 1.9. I'm up $40 a contract. My risk was $20. That's a 1-to-2 ratio right there already. So I'm always trying to calm myself, not after I enter. I don't care about entering and then calming down. I want to enter calmly before. If I'm like questioning the position, if I'm thinking to myself, I don't know if I should do this, I'm not going to enter. Say the contract is at 1.5 and I don't enter, then it drops to 1.3, 1.2. At that point, I can readjust. Where's another entry point? I can get this for even cheaper now. Before I wanted to size 2 contracts at 150, I can size 2 contracts now and I'm saving an extra 60, $40. Like you have to figure this out. That's how I do this. So as you size more, obviously you're going to risk more, but you're also going to have a higher reward if you're correct about the setup. So for the example, sizing 3 contracts at 1.5 and having a 1.3 risk, you're risking $60. I'm going to keep repeating this part right here. If you stick to your plan, if you stick to what you have figured out before entering, if you just enter and don't sell at 1.3, the entire mindset is destroyed. The system's destroyed. You didn't follow the plan. You're risking more money than you afforded to in the beginning. Now you're emotional. Say it drops to 1.1, you don't sell at 1.3. Now you're telling yourself, do I want to sell at 1.3 if it bounces back? Do I want to sell at break even if it bounces back? I can promise you this. If you hold the 1.1 and it bounces back to 1.5, you're not going to sell. Your mindset, I'm back to break even. Let's see how this plays out now. I was just down $40 a contract. Now I'm back to break even. Let's see what happens. No. Like that's the only word I can say. No. Rocky, I'll get to your statement in a second. So the way I manage a risk that's down, if, and I say if, I hold past a set loss I have. If I enter at 1.5, stop loss is 1.3, and I hold the 1.1, right away my mindset, I'm thinking, okay, I entered this contract at 1.1. I just want to get out at 1.3 because that's a $20 contract save I just made on myself. Or say it goes back to 1.5. I just saved myself a $40 loss per contract. I don't care about finishing green. I just want to get out of this trade. I do that so often. And the fact of the matter is people will say, oh, well, you had a trade that went from 1.5, you sold at 1.5. Like, why is that a good trade? Some people may have scared themselves out of a position at 1.1. Then they see it go to 1.5 and they're thinking, man, I should have held just a little bit longer. I would rather sell for break even than sell for a contract at a loss where I'm still thinking to myself, this could come back. That's why I size light. If my risk, let's say my risk is $200. If I size one contract, I can hold that to zero. I'm saving $50 from the way I just explained that example. So say you size 30 contracts. Right away, you know my risk is $600. I'm sizing 4,500. My risk is $600. Can you risk $600? If you can't risk 600, size 10 contracts. Can you risk $200? All of this matters if you stick to the plan. If you make a setup happen, a plan before you enter, and you follow it. If you don't follow a plan, you can't track it. You can't journal it. All you can say is, I didn't sell when I was supposed to. You didn't learn anything except the fact that you can't follow through on what you tell yourself. You're lying to yourself. You're ruining your mindset. Now you're not even going to execute on a solid setup because your mindset is last one I entered, I lost. I didn't get out in time, blah, blah, blah. So going back to Rocky's statement, he said, I love this technique. Entry at 1.5, stop loss at 1.3. But my only problem is I always feel when I have a stop loss, these institutional traders, aka the market movers, always stop us at our stop loss, and then the option moves our way. So what I do is I try to size for zero with high quality setups. That's exactly what I do as well. If you're worried about what if the 1.3 is too tight and it goes to 1.25 and then it shoots right back up, size for a point where a $20 loss a contract is not a lot for one contract. So instead of sizing $1,000 and you have to sell at 1.3, size half of that and hold it to 1.1. So if you size 1,000, sell at 1.3. If you size 500 and sell at 1.1, you lose the same amount of money, but you have more of a gap for a pullback if it happens. Peg said, that happened to me so many times. Down on a play, it comes back to break even. I don't take it off. Then it goes back down on me even more. Need to make this a firm rule to get out. The best thing I can say about that, mindset wise, this is not like you can't just execute. You can't just tell yourself, if it goes back to break even, I'm going to get out. Because human nature, you don't want to just get by. You want to do more than what's required. You want to finish green on a trade. That's just human nature. The best thing I tell myself, I repeat, I just entered at 1.3. I just entered at 1.1. Say it dips to 1.5. I just entered at 0.5. I just entered at 0.5. If it goes to 1.0, that's an 100% trade. I'm fine with cutting right there. I focus on if I would have entered at the low where the contract currently sits, even though I'm red on the trade, think about how it pulls back on that dip. Other people bought at that 0.5 entry. Other people, when you got stopped out at 1.3, they bought at 1.3. So pretend like as the stock drops on you or the contract drops on you, you're entering at that price. So then if you enter at 1.5, it pulls back to 1.0. You didn't sell at your stop loss. So now you're thinking, I just have to get out. If a 1.0 entry goes to 1.3, that's a 30% trade. Yes, you are still down from the 1.5 entry originally, but focus on the pullbacks. Is there really enough momentum to bring you back to break even? Is there really enough like motion in the chart to get you back to green on the trade? Sometimes cutting your losses small is not as bad as holding and hoping. And the next thing you know, you're down 90%. And then you sell, and then it comes right back to down 20%. It's not bad to sell for a 10% loss, 20% loss. Because if you have, say, 10% losses, 150% trade, you're back to green overall. 2 losses, 1 win. The win-loss ratio is not good, but the perspective of percent gains, your account is overall green after those 3 trades. That's what I try and implement into my trading. Small losses, bigger wins, let the runners run. Rocky said, basically, even if it's a high-quality setup, I size very, very light, just 1 or maximum 2. Now, Rocky, type this out for me. If you size very light on a position, even though it's a high-quality setup, your mindset is, I want to size heavy. This is the one. You still size light. How hard is it for you to hold longer when you size 1 or 2 contracts when you originally wanted 5 or 10? How much harder is it to hold when you size 1 contract? Vic said, do you set your stop loss right after you enter the play or do you manually exit? So when I first started this, I don't want to say strategy, but when I started making this system for myself with my own personal bias and my emotions, I would set a stop loss only because I knew right away I was not going to follow it. I knew who I was as a person. When I'm down, I don't want to get out. Now that I'm focused on the idea of the long term, I will manually sell the contract. I don't have a stop loss. I will just watch and let it happen. I will sell right away. I'll deal with it. The biggest thing I do though, I gave this example of a 1.5 entry and a 1.3 sell only because that's more so if you size 10 contracts, 20 contracts. If I size one contract at 1.5, I personally can hold that to zero. But if the chart setup flips the bearish and it's looking horrible, I'll sell the contract at any point if the chart looks bad. I don't care if the contract's at 0.6, 0.7. If I know for a fact it's not going to come back, I will sell, and my mindset right away. I just save myself from losing an extra so-and-so amount of money. I don't care that I lost this much. I save myself from losing the rest of that position size. Doc said, honestly, I don't set stop losses on any of my trades. I have a mental stop loss because I have always seen people get wicked out. That's one reason when I first started doing this for myself, I would set a stop loss, I would get wicked out, and it would bounce right back to my entry point, if not 20, 30, 40% gains. So at that point, I learned size less, don't put a stop loss. As I got better at it, I figured out my hit ratio of wins to losses. I figured out my losses were this small of losses. My wins were this big percent-wise with wins. So I started sizing heavier because my conviction to sell for a loss was getting better with myself. I wasn't the type to hold on to a position hoping it would come back. I wasn't the type to size down to make my average smaller. So if it does push back, I'm fine. I would just size to the point where I can let it do whatever. Like whatever happens, happens. I've had people tell me, how do you size that much so late in the day? That's a huge risk. I size for zero every position, no matter how much money it looks like I put in, I can lose it and not care. I don't enter a trade oversized and think to myself, if this goes to zero, I'm destroyed. I'm going to cry. I'm going to be so upset with myself. If I feel that way, I don't enter, or I'll just buy one contract. And then if I win on that trade, I can track it on my journal. I had a trade that went 50%. I only had one contract, but I held through a 20% loss and it came back. I'm always trying to figure out like the journey to where I sold, not just the idea of I bought, I made 50%. Let's do it again tomorrow. Was the trade down when I entered? Could I have entered at a better price? Was there a way I could have waited longer to see the chart form before I entered too soon? I'm trying to find stuff that people don't talk about to improve my trading. No one talks about the hold you had to make profit. All they care about is my entry was this, I sold it this is why I did it. Well, what would you have done if it went the wrong way? That's all I want to talk about is what happens if it goes the wrong way. Because when it goes green, a lot of people don't care. They're just happy. I'm up 10%. I'm up 20%. When they're red, man, I'm down 10%. What if it keeps going? No one's focused on like huge gains when they're red. All they're focused on is I'm going to keep losing. When people are green, all they focus on is what if it pulls back and I go to red? Does that make sense to you guys? This is obviously a biased statement I just made, but I feel like that's how a lot of new traders are. Like when they're green and it starts to pull back, they're so scared about it's going to go red, I have to get out. But when the trade's red and still dropping red, they're not focused on this can go green. Or they're not focused on this is going to keep tanking, I'm screwed. They would sell if they would think that. So I feel like the roles need to be reversed. When you're in red, you have to focus on, okay, if you're thinking this is going to keep going down, like I made a bad position, your size too heavy. If you're in the green thinking about this is going to go red, you may have size too heavy. Now you don't want to hold through the chop. Rocky said, bro, sizing light, I have entered at the lowest and sold close to the highest, and you know it because I'm more confident and I know it's within my risk tolerance. But in my initial days when I used to size heavy, I used to be praying every single trade I take, and I would always get anxious. And yeah, and he would DM me and just tell me, like, what should I do? I know you're good for the typos, man. Doc said, to put this into perspective, I'm going to speak in first person for you, Doc. To put this into perspective, I had a 4120 call. I had 3 contracts for a position. At one point, I was down 50%, and it ripped all the way back to almost 5,000% when I sold my runner. But I was convinced in the chart that I saw that I even saw it move slow. But yeah, I know a lot of people, when they're oversized, they will sell down 30%, 40%, 50%. If you're sized 3 contracts, I'm not saying this is you, Doc, but I'm just giving an example for people that are listening. If you're sized 3 contracts and you are selling early because you're scared, say it comes back and goes 500%, it goes 1,000%. You're going to be pissed off. You're going to size heavier next time and try and catch the move. You're going to hold through red because, oh, well, last time I was down this much, it came back. So I'm going to keep holding. Size one contract and watch how you have no emotion. Size in 3, selling at 50% loss, say you lose $200. Now, say you size one contract that is $200. If that goes to 0, you had the same outcome of selling early on 3 contracts that came back and went 500%. Now you have one contract that's down 50%. You don't care. Now when it comes back, you're emotionless. Now you're focused on, okay, at this point, I can put a stop loss in profits. The chart's looking extremely bullish. I can keep holding this. So you're focused on the move now. You're not focused on the scare tactic of, I got to get out of this. Now you're focused on the chart. So going off the 1.5 entry and the 1.3 stop loss, I basically broke this down into a percentages of like risk reward just to see. I know a lot of people are visual learners. It's hard to understand when I just talk. So I typed a few stuff that it may be a little discombobulated. So any questions or like, this isn't right, please mention it so I know. But say you're up, once up 0.2 on the contract, if your risk, and let me move this up so it's out the way. There we go. So once you're up 0.2 on the contract, your risk initially was 0.2 for a loss. So once you're up 0.2, the risk to reward is 1-to-1, which means if you follow this plan and you buy and sell at 20% gain, 20% loss. For a loss, you sell at not 20%. At 0.2, you sell for a loss. Up 0.2, you sell for a win. 50% chance long-term of a win-loss. So every win, you have a loss. Every loss, you have a win. It's break even. Now, say one time that you hold a contract, it goes from 1.5 to 1.95. You just made $45 on one contract. Your risk is $20, obviously. Your reward was just $45. And this is actually a little bit off. That should be like 2.33-ish. So now your risk reward is basically a 1 to 2.3. You made $45, your risk was $20. Does that make sense? So at that point, now for every trade you take that you lose, say you lose one trade, you lose another trade, then you have a winning trade, you're up overall. On a 30 to 40% gain, you are up overall after having 2 losses that you cut for 0.2 contracts each price-wise. It's all about percentages. It's all about sizing properly. It's all about how to find or determine the outcome. Like finding the outcome gives you a leg on this that no one really focuses on. It gives you an advantage, not statistically, not financially, but emotionally. Emotions are the biggest killer with trading. I don't care what anyone says. It's not learning. It's not knowing setups. It's not following EMAs, following indicators, following zones. If you don't have emotions under control, you can't trade properly long-term. One major loss, you're trying to chase it back. You oversize, you lose again bad, your account's gone. But the one time you hit big, you're going to try and size heavy again and hit big. You're going to lose. Then you're going to try and chase it back again. It's a non-ending circle of just consequences you have to deal with. So when sizing properly, everything follows suit. And obviously this example goes with the one I fixed above. But let's just give an example of me switching this to, let's do 2.10. So say the contract, the one you bought at 1.5, it runs the 2.1. At that point, using this example below, for every 3 losses you have, as long as you hit 1 win of this example on the screen, you're break even. 3 losses, 1 win, you're break even. If you have 3 losses of losing 0.2 a contract, that's 0.6 total. If you have 1 win of 0.6, you're break even. 3 losses, 1 win, that's it. Now imagine your hit rate is 80%, 75%. For every 3 trades you take, or for every 4 trades you take, you lose 1. That's a 75% chance of you making money on a trade. Imagine having that win to loss ratio on a trade with a risk to reward ratio of 1-to-3. Every 4 trades you take, you lose 1. Well, for every 3 trades you lose and 1 that you win on, you're break even. Think about that real quick. It doesn't matter if you size heavy and you hit big. It doesn't matter if you size light and you don't hit big enough. If you stick to the same proper sizing, the same correlation with every single trade, look at the long-term goal with this. Don't focus on, I got to make 2,000 tomorrow. I've never hit 4 figures in a day. I want to make $1,000 so bad. If you've never made $1,000 and you oversize the next day and you finally hit $1,000, how are you going to keep that money when you just oversize to get the money? What if you oversize again and then you lose the entire amount within a week? Now you're back to the thought of like, what did I do wrong? What made me lose this money? The consistency of sizing properly, of trimming a loss when you have to, of selling in profits when you have to. When you have a probability in front of you, like what's on the screen right now, for every 3 losses, 1 win, you're break even. But your win to loss ratio is basically a 75% hit rate. So you're only losing 1 trade out of 4. So imagine hitting 3 wins and 1 loss. Your account it's booming. You just have to stick to the plan. That's all it is. Even if you have a 75% hit rate and say you buy a contract at 1.5 and it runs to 1.7 and you sell, your risk is still the same as the reward, a 0.2 contract move. With the hit rate of 75%, for every 4 trades, you're losing 1. So that 1 trade, you lose $20. The other 3 trades, you made $60. You're up $40 overall. What's wrong with that? People are so focused on what I lost, though. I lost. Long term, you're going to compound your account so quick that by the time you realize it, you're sizing 1,000 a position. You're sizing 5,000 a position. And by then, you'll be up 10% and you'll be thinking $500 on 10%. This is crazy. Or $1,000 on 20%. This is crazy. And before you were trying to get to that point, 20% was only $40. 20% was only $35. Notice the long term with this. Figuring out what's going to happen before you enter limits those emotions. It gives you an advantage that most traders don't have on the retail side, and that's patience. That's no like freaking out moments. You're not focused on, oh, I'm down 80%. You're focused on, I size for 0. I can hold this. If you oversized, you have to sell at your planned stop loss, whether it's mental, whether it's you set it and now it's staying there. You can't just do this stuff on the fly. This setup, I saw it go 1,000% before. I want to get in full port because what if it does happen again and I miss it? The one time you do that, setup doesn't happen. It fails. You're down. You don't want to sell because it may come back. Next thing you know, your account's at $0. Or you sell at 90% loss, then it comes back to 50% gains and you're pissed off at yourself. You have to size to how you feel as a person, your personality as a trader, your personality as a person in life. Can you afford to hold through red? Can you afford to risk X amount of dollars? If you know who you are, I can't risk $200 on a trade. Don't size over $200 because then if the trade goes to 0, you're not losing $200. It's all about thinking. Like, it's not just about I have to enter, I have to make money. How are you going to manage a risk on the downside if you're wrong? That's what I hope you guys are like picking up on with this. I'm going to scroll back up to a journal checklist I do. This is all mental for me. I had to write this out when I first started, so I kind of typed up what I remember because that journal has been full. I don't even know where it's at anymore. This was years ago. But the stuff that I remember, I would always ask myself on a checklist. I would literally go down my book. I look at my checklist. Is this working with this setup? Yes. Is this working with the setup? Yes. Okay, can I answer this question with the setup? Yes. What zone is best to wait for? Say a stock's at high of the day. Do you really want to enter calls at high of the day? Some people will say yes, it's going to keep running. Someone like me, where's the zone below that if this pulls back, it's going to rip? Perfect example was today with S&P. It tapped out at 4,100, and I was telling people 40.88 is going to be that supply zone. If it dumps to 40.88, we're going to push right back up. Within not even 3 1-minute candles, we were back to 4,100. We ran 10 points in not even 3 minutes, I think. I'm always waiting for that pullback. I don't care about chasing a play because IV is spiked. People are already chasing, so the price is higher than it should be. The minute that pulls back, I don't want to be down 30% already. So I'm always telling myself, what zone is best to wait for? Is there even a zone for this setup? If not, why am I looking at this getting FOMO? I'm just not going to look at the chart. What's the con price if I enter there? As in, what's the con price if I enter at that zone? I pull up the contract chart. I look to see where it was historically at the same price action on the stock. I try and calculate, will it be the exact same price? Will it be a little bit lower? I try and include the probability move off of the intrinsic value on a pullback. Or if I want puts, I'm calculating the contract price if we push and the IV drops the contract quicker than where it was historically at the double top. Where would my risk be? All of these questions before I even enter the trade. It's setting up and I'm watching. Where's my risk if I enter at this zone at this contract price? I'm writing this down. I'm calculating this in my head. At this point in my career with trading, I just think about all this in my head. If I enter a contract at a pullback at 2.5, contracts currently at 3.4, so I need a 0.9 pullback. If I enter at 2.5, what is my risk? Okay, let me look at the chart. Okay, if we drop 4 points on SPX, this is going to be a heavy zone. If that breaks, I have to get out. What was the contract around that price last time? Let's say it was 1.8. Entry is 2.5. My cut mental is 1.8. I'm risking $70 a contract. How much can I afford if I size a certain amount of contract? Can I risk $50? Can I risk $700? If I can't risk $70, like just 70, I'm not even going to buy the one contract at 2.5. This is how I think about all this stuff. Okay, what's the possible risk to reward if the setup on the chart works out how I plan? So if it goes upside in my favor with calls, where am I going to sell at? What's the chances of another zone above hitting? What would the average cost of the contract be? So say my entry is 2.5, my risk is 1.8. The upside is like a 4.0 if we double top high of the day, which that's what SPX did today. It dipped down. I think the low on the contract I was watching was 2.41. I wanted 2.7. That 2.4 low ran right back to 4.0. So when I figure this out in my head, let me type this out so it's a visual for some of you. Why is it not scrolling? There we go. So let's say entry is, what's still 2.5. Risk sell is 1.8. So just going off this, you're risking, I typed that wrong, I'll fix it in a second. You're risking 70 a con. $70 per contract you're risking. Where's my mouse? There it is. Come on. You gotta be kidding me. I know that's spelled wrong. So you're risking $70 a contract. Say your risk is 100, like say beginning of the day or during this trade stuff, you're thinking I can risk $200. If you size one contract, your sell based off I can risk $200, you're selling at 0.5 a contract. Your risk is a 0.5 sell. If you're sizing two contracts, if you sell at 1.8, you're risking $140. I'm calculating this before, so I know, okay, if I size 10 contracts, I'm going to lose $700 if I'm wrong. I know all this before entering. So when it does happen, I'm not thinking to myself, do I really want to sell if I'm down 700? I told myself I was going to. I have to be truthful with myself. I have to be honest with myself. The minute I say I'm going to do something and I don't do it, you just lied to yourself. You broke that connection. You're not going to trust yourself moving forward for a buy entry, let alone another sell entry. People don't think about that. When you lie to yourself or tell yourself you're going to do something and you don't do it, you get comfortable with the idea of, I don't have to do that next time because I felt fine not doing it. Or I should have listened, but I just couldn't do it. You don't want to put yourself in situations from a self perspective of, I'm going to do this, and you just don't do it. Think about how you feel when someone else tells you they're going to do something for you and it never happens. How disappointed do you get? How like looking forward to, oh, they said they were going to do this. I'm waiting. Don't do that to yourself. If you tell yourself you're going to do something, you have to follow through, and the long-term compound interest on trading will benefit you exponentially. There's no ceiling to this, honestly. There's no like, I'm going to hit $1 million and I'm done. There's no way I can do more. You have more to work with. Same risk, same reward, same probability rate. You just have more money to size in. More to lose, more to gain. And of course, I basically talked about that without reading the question, but what will my sizing be? If I enter this contract, what is my sizing? Am I sizing 5 contracts at 2.5 entry? Am I sizing 1 contract at 2.5 entry? You already know, one, your entry is going to be this, even though the price of the contract's at this price. Let me type that in just so it's up there for visual again. Let's say, I'll just say 3.2. So current price of the contract is 3.2. You want an entry of 2.5. Even before you fill, you know my risk is 1.8. I'm risking 70 a contract. How relieving does that sound? Knowing before you enter, you're risking $70 if you buy only one contract. There's no freak out of, dang, I'm down 40%. Dang, I'm down $100. Man, I sized too heavy. Figure this out before you enter. Even if you can't pinpoint it dead on, have a rough idea. This contract will be roughly 2.0 to 1.7 if I sell for a loss. Have an idea so you know how to size before entering. Don't worry about, oh, this could run 1,000%. None of that matters. The only thing promised in trading is you're going to lose. Wins are not promised. Losses are always going to happen. That's one thing I tell people. Wins are not going to happen and no losses are ever going to happen. Losses are always going to happen. A win is never guaranteed. A loss is always guaranteed. Every time a loss is guaranteed. So when you play, you have to play for a loss. You have to size for a loss. You have to prepare for the worst side of everything so that when the upside does happen, you're not freaking out like, oh, I'm up 30%. When should I sell? You're still going to be focused on, okay, the chart's holding, the zone's holding. You're not focused on money now. You're focused on the chart, the setup, the move is happening. I'm in the money now. I can hold a little bit longer. I can put a stop loss at 10% gains. I just locked in a 10% gain no matter what happens. Once you're in the green, you are in control. If you don't plan beforehand, you're in the red, you're not in control. Your emotions are. So I try and decipher emotional standpoints and then stability standpoints. I don't want to interact with that at the same time before I plan for it. So I want to know everything before I enter. I want to know my risk. I want to know the possible reward if my level holds. I don't only focus on the reward. I just want to have an idea. Is my risk to reward a 1-to-1, a 1-to-2, a 1-to-3? What could it possibly be? Every trade I take, these thoughts go through my head every single time. And then, of course, this is one thing that I plan on doing a class with this later on. This is going to probably be a two-part section because the Greeks are kind of complicated when you include the delta, the gamma, the theta, the IV, intrinsic value, the vega. There's a lot to break down with that. But when you're looking for an entry and a sell point, you have to correlate the Greek prices with the contract price. Even though a heavy sell-off will make it drop quicker than it should, you have a rough idea. If a contract is 1.5 and the delta is 0.5, you know for every dollar move on the stock price, you're losing 0.5 a contract. It may be more or it may be less if it moves a certain way, but you have a rough estimate idea. Correlate that price action move of 1 point based off the zones now. Does that make sense to everyone? If not, let me know and I can try and break it down a little bit smoother. You're using the Greeks to figure out with the price action on the stock how much a contract will move based off those moves. So when doing that, I've said this I don't know how many times now, you'll be prepared. Be prepared for both sides, not only the winning side. If you know what the risk is, there's no emotions when a loss happens. You're content because you planned. That's all I can really say with that part. I'm going to scroll up and see what else I had up here. Okay, so depending on which contract premium correlates best with the price action of the stock, the idea is to play a safe contract. I saved this for last because now that you know the risk, now that you know the possible, like you're planning before you enter, this is the part to end on so you can process everything that just happened along with a safe contract entry. Obviously, this was one of the last classes I did with the golden contract, how to find the best contract with low risk, high reward. If a share of Apple is at $161.30, I think everyone knows the contracts for Apple is like every 2.5. So 162.5, 165, sometimes every dollar. It all just depends. So when you're playing a contract of Apple, if the share price is at 161.3, I personally look at the closest call to in the money. I don't care about the 165, the 170. I want low risk and I want the contract to move in sync with the actual price action of the stock chart. I don't want to be freaking out over a huge red candle and I'm down 40% for no reason. I want to play right at the money because once I'm in the money, everyone should know how in the money contracts work. They hold value. There's no shakeouts. Once you drop back out of the money, That's when things heat back up again. But by then, you should have trimmed already. You should have sold for profits. It all depends on what the setup is based off you and how you feel. But yeah, so this, I'll try and end on a good statement. I try and end on like a good closing segment, I guess you can say. We have 7 minutes left until 9 o'clock. So any questions you guys have, any statements, any thank yous, any problems, start typing them now. And I'm going to just talk briefly on some other stuff real quick. So a few things I wrote down on my notepad here. I just want to recap the biggest thing that I feel about. Where is the cut? Where is the sell zone? Compare the option chart with the stock chart. Find a zone that if this breaks, the validation is gone. The setup is gone. Your risk is even more. Your reward's even lower. You have to plan. You have to figure this out well before you size in. If this is not your type of style, figuring this all out before you enter, that's fine. Keep doing what you're doing. If you're successful, that's fine. I'm teaching you what I do. I'm teaching you my style. I'm teaching you the lowest risk possible. I'm teaching you how to plan before what happens affects you emotionally, and you can't think stability wise. You can't think smart. You can't think in the moment because your mind's racing. You're down this much money. You oversized. Plan before entering. Knowing the price before a loss limits your emotions when you enter. If you know the possible loss, if you stick to the plan, if you stick to the system, there's no emotions when you sell for a loss because you plan for it. You were expecting this was the loss if I sold. So when it happens, that's the result. You won that trade because you stuck to your plan. Whether it's a win or a loss based off P&L, you won a trade if you stuck to your plan. That is how I feel. If you plan for a 20% loss and you sold for 20%, a 20% loss, you had a winning red trade. Does that make sense to everyone? A lot of people are like, how is that a win if I lost? You told yourself you're going to sell at 20%. What if you sold at minus 40%, minus 50%? How is that something to be happy about? Your plan was to sell down 20%. You sold down 50. I would not be happy with myself because first of all, you lied to yourself. Second of all, you lost double what you should have. That's the biggest thing right there. Okay, the purpose. Know the percent loss per contract. When you know the loss per contract, you know how much the size per position. If you know you're going to lose $50 a contract if you sell when you say you will, and you can't handle a $500 loss, why are you sizing 10 contracts? Why are you sizing 5 contracts if you can't handle a $250 loss? Literally, like CJ, mindset. Everything is mindset with trading. I've heard this quote. It may not be as accurate as I've heard it, but literally trading is 20% technicals, 80% mindset. Or maybe it's 10% technical, 10% mindset, 80% emotional. Like emotions and mindset overtake everything. Technical analysis, the tape, everything. If you don't have a clear mindset, you will not be able to trade because you don't know what to follow. You can't stay stable in uncomfortable situations. So risk is known, play the chart. Once the contract is up, you are in control. When the contract's in your favor, you are in control. If you plan for a loss, when you're down on the trade, you are in control. You plan for the loss. So you have to realize, end of the day, when you win or lose, you lost, you won. It's not the market's fault. It's not, oh, the market makers wicked me out. They just knew I was there. If you plan ahead of time, there's no blaming anybody. The plan worked the way you figured it out before buying. You can't switch up, oh, I shouldn't have sold there. You planned it. You followed through. Don't break that trust with yourself. Everything is about mindset. Everything is about the discipline to stick to your plan. Everything is about limiting the emotional standpoint from trading. So you're only focused on the chart. You're focused on the probability rate. That's all that this is about. So any questions you guys have, anything you want me to speak more about, let me hear it real quick. If there's no questions, I'm going to be surprised, but I try to leave some gaps in there so people are kind of left questioning a certain section if they have to be. So anything on your guys' mind, just let me know. Hopefully this was, I don't want to say an eye-opener, but at least it made you find a new perspective on how you could trade or implement your own type of style with a twist of what I do. Maybe you don't plan and you just enter blindly. Maybe you should start trying to see like, oh, I could enter this contract a little bit cheaper and I can sell where I initially wanted to enter the contract. If I wanted to buy at 1.5, I could wait and buy at 1.3 and sell at 1.5. Doc said, let's talk about Amazon after hours. What happened? Netflix 2.0, my man. Inverse Netflix 2.0. Netflix dipped, came back. Amazon ripped, came right back. A lot of speculation of what could happen after that. But is there any questions with the class? Anything at all? If not, just say no in the chat so I can stop the recording. We can talk about other stuff if you guys want to. But any questions about discipline, mindset, planning a trade before entering, how I personally sell without an actual stop loss, how I just do it mentally, how I size properly, even though I may miss a trade. Perez said, thanks, Breezy. Great class. Really. We'll start getting contracts closer to in the money. See how it goes for me. Great night, Jules. The hardest thing about playing at the money, they're going to be more expensive, obviously. So you may have to find other tickers that are cheaper based off contract premiums. Playing Tesla at the money, expensive. Playing Amazon at the money, expensive. Playing SPX at the money. I don't even want to say expensive. It's outrageous. You want to play what correlates with your account. That's how I feel about it. If you have a small account, I don't even think you should be watching Tesla, watching SPX. SPY's relatively good, but it moves quick. There's a lot of stuff you can look at that move amazing. I alerted DraftKings, it ran 2,000%. It was a $4 contract. People don't want that until it happens. People want the SPX that goes from $200 to $400. How would you feel sizing $4 and making 70 in return? It's one of those things. Yeah, Doc, I got to keep bringing up DraftKings. I know. Got to keep bringing it up. But yeah, you guys are welcome for the class. Let me stop the recording.